Well, how are you? My name is Roberto Dargerandi, and I am the professor in charge of this course on accounting, financial decision, and control in the MBA program at Blackwell International University. In this second session, we will continue discussing the main aspects associated with financial accounting. All types of organizations, particularly private organizations. And for that, we are going to continue with the theme we were discussing in the previous session, as you can see below, where we were talking about different types of accounting: financial accounting, tax accounting, management accounting, etc. Here is a small example of the difference between tax accounting and financial accounting. We have a company, for example, that has a financial result or profit of 122,330. In this case, Peruvian sols. In contrast, in the tax base, we start from the same result of the period, but certain adjustments are made to arrive at tax accounting. For example, a fine from the National Superintendency of Tax Administration is added. Additionally, expenses from receipts issued by entities that are not registered are added or adjusted. Additionally, there is an excess of depreciation allowed for tax purposes. And what does that mean in summary? It means that the financial accounting profit in this case would be 122,330. The tax profit for tax payment purposes would be 147,930. And we need to be clear that many times companies mix tax issues with financial ones. And here it must be made very clear that these are parallel paths. But what we will normally be prioritizing in this course is financial accounting. So, moving forward with this site, take the opportunity to introduce a concept that is very important, which is the concept of deferred tax, which can be either an asset or a liability. When it is an asset, it means that there is a difference between accounting and tax regulations, and the taxpayer should pay a higher amount of taxes in the future, with future understood as the current period, in the near future. But the important thing is that one could recover that higher tax payment in the following periods, sometimes due to differences. For example, the tax depreciation of an asset may be 3 years, while the financial depreciation is 5 years. Or vice versa. This creates an intertemporal effect. On the other hand, a deferred tax liability rises when the taxpayer effectively pays lower tax but still owes part of that tax, which must be paid in subsequent periods. In this case, it is essentially a debt. In the case of an asset, it is a matter of a liability. So, when we read about deferred taxes, which is something that is normally discussed in all tax-related topics, we need to know whether it is an asset or a liability, and the consequences of both alternatives. Now, moving on to the components of the financial statements. These are associated with the balance sheet, which is something we will discuss next, as it is a snapshot. An income statement, which is a movement of revenues, costs, and expenses, including taxes, and cash flow, which consists of cash inflows and outflows that occur over a specific period of time and that normally, for example, will differ from the income statement. Also, a statement of changes in equity, how it develops and how a change in equity is verified during a specific period. And finally, the notes to the financial statements, which are always something very relevant. So, looking at the components of the financial statements, as we said, there are these 5, mainly the first 3. The balance sheet, which is also known as the statement of financial position, the income statement or statement of comprehensive income, and the statement of cash flows, along with the statement of changes in equity and the notes to the financial statements. And the first 3 are usually what one is looking at, but for example, annually when companies, they publish or generate, for example, because if the closed company is not going to publish its financial statement, well, we see these 5 components and normally we focus on the first 3. However, we must not lose sight of the statement of changes in equity, as it provides valuable information, and of course, the notes to the financial statements, which often contain important information that helps to understand the previous statements. And sometimes complementary information, often qualitative, right? That is very, very relevant. So let's not lose sight of the fact that we need all the components of the financial statements to better understand how the company is doing from a financial perspective. But we also have certain examples, and the first three are what we are going to focus on in the following sessions. So, specifically addressing the financial position statement, commonly referred to as the balance sheet, we need to understand that it represents the accumulated financial situation of the company or organization at a specific point in time. That's why we say it's a snapshot. Snapshot, right? How the company is normally, at least at the close of each annual fiscal year, tax year, or as established, and also many times, sometimes, quarterly or monthly. Even at the extreme, I could have a weekly or daily balance. And this is shown through the three main components: assets, liabilities, and equity. So, better understand and define each of these items. Let's start with assets. An asset is a good or a right that the company possesses at a given point in time. They are resources. Therefore, this good or right is controlled by an entity over which the company, of course, intends to generate benefits in the future. So, everything that a company owns or has the right to at a given moment in time should be considered an asset, and that asset should somehow be defined by the ability to generate cash flows, profits, or generally future benefits for that company or organization. On the other hand, we have liabilities, which are nothing more than the company's obligations to third parties or the rights of individuals over the company's resources at a given point in time. This is referred to as debt. In other words, it is a present obligation based on past events that will involve the outflow of economic resources in the future. If I, for example, have a debt with a bank as a company that is due on the 1st of December of a year, well, I know that on the 1st of December I should either go in person or electronically, however it is done, right? And transfer resources, for example, that allow me to extinguish that liability, right? And of course, conversely, the creditor has certain rights to collect that liability, right? Especially in the case where there is a delay or the payment of this liability is definitely not verified. On the other hand, we have equity, right? And equity is an amount of resources that constitutes the company's debt to its owners at a specific point in time. In other words, it is essentially the quantity of the owner's rights in the company over the difference between the assets and the liabilities of the company. Equity must be both accounting and economic. The difference between what I have, the assets, which we refer to as goods or rights that allow me to generate future benefits, and the liabilities, which are my obligations to third parties. That difference is what is understood as the equity of a company or a specific entity or organization. And therefore, here we are, probably at one of the, not the most. It is important to consider equations when we talk about the accounting and financial scope of a company, which is the basic identity, the fundamental identity that indicates that assets, which are what I have and what I expect to generate future benefits, must be equal by definition to the liabilities or debts plus the equity of the company. And therefore, this equation will always follow us in the field of accounting and in the field of finance. Because, in essence, there will always be a liability or equity behind an asset. And here comes what we talked about before in the previous session regarding double entry accounting. So, this equation is one that we not only have to learn, but also understand very well in order to be able to apply it mentally, numerically later, right? When performing an analysis make a calculation regarding a company's balance. So as we just taught, right? In this way, with this equation, we are also formalizing this principle of double entry, or what is called the equity equation, which is, as stated here, a cornerstone of the accounting. Company or organization. Therefore, in other words, this equity issue is the result of comparing the resources owned by the company, which are the assets, with the internal obligations, which are the equity, as well as the external obligations, which are the liabilities of that company at that point in time. So, what we are going to do now is set an example to understand this concept. So, let's assume that a company is created at a certain point in time with a capital contribution of $1 million. That is the beginning of the company. A capital contribution of $1 million. Well, from the basic identity, write that assets equal liabilities plus equity. We can say, in this case, right, that the first balance after making that capital contribution would be, on one side, there is equity, the capital of the company that is created. On the other side, there is the capital contribution. Let's assume that this capital contribution, if it is cash, would be recorded as cash in an account that the company has. And there would be, by definition, equality. In other words, this equality must always be present at every moment in time. Now, what happens if, based on the previous information, a loan of $2 million is requested? $2 million. Well, here we will have to consider that two things will happen. On one hand, on the liability side, a liability of $2 million now appears, which adds to the previous equity of $1 million, and therefore the other counterpart is that the asset also increases or grows to $3 million. Let's assume that this loan is also in cash, so now we would have an asset, cash, or money in an investment account, or $3 million. This must equal the liability of $2 million and the equity of $1 million. And what is the same? Could now calculate at net worth as the difference between everything I have, those $3 million in cash or in investment accounts, minus that liability, $2 million, so we are always playing around. We should always arrive ultimately at this fundamental equality in accounting and finance. So if we look at the same thing, we will have that in the balance sheet we have. Assets, properties, rights, and others. We have liabilities, which are obligations to third parties, to banks, to suppliers, to employees, and for taxes. And we have equity, which ultimately is the obligation that the company has or the assets of the company with its owners, in terms of contributions, shares, and accumulated profits that exist. Therefore, this quality must always hold. If at any point it does not, there is a problem or a serious error in that accounting. So, now breaking this down, we need to understand the following in greater detail. To make a finer, more detailed, and ultimately more useful analysis, it is good to break down both assets and liabilities. And how do we break it down at least? Into two main categories. Those that are current, which are also referred to as circulating, and those that are non-current. When we talk about current assets or liabilities, we are always talking about assets. Short-term liabilities, and short-term is understood as a period of up to 365 days, within the next 12 months. When we talk about non-current assets or liabilities, we are referring to components of the balance sheet that are due or will generate benefits as either liabilities or assets beyond 12 months, starting from the 13th month onward. And going forward, it could be month 15, it could be month 25, it could be month 150 as established. Well, and the difference, as always, is between current assets. More non-current assets minus current liabilities and non-current liabilities is what is called the company's equity. Therefore, it is always important not only to talk about assets, liabilities, and equity, but also to break down assets and liabilities into at least current short-term and non-current long-term categories. And then, of course, each one should open it to have much more precise and much more detailed information. So, here is an example. Current assets, as we mentioned, are those that can be made liquid or can generate benefits in less than 12 months. For instance, they include goods, cash in the register, money in my checking account, short-term financial investments, but also as they are under inventory, which are also goods. But there can also be certain rights, for example, debtors from sales or accounts receivable, which is what is owed to me. For example, I sold a service, issued an invoice or a receipt. And as long as that receipt or invoice is not paid to me, not canceled, I have a right to be paid for a service I have already provided or also for a good that I have already delivered and sold on credit. And alternatively, right, we have non-current assets, which are those that effectively have periods longer than 1 year, as we mentioned, and there are the typical assets: land, properties, machinery, and intangibles. What are intangibles? For example, a brand, a patent, such as a patent to operate a restaurant, a key money right, etc. And other assets that, for instance, if the company has investments, minority shares in another company, well, other assets would also be included. So this is one way, right, to classify more precisely current and non-current assets and, in turn, the components of each of these categories. On the other hand, liabilities, right, they are also classified into two types: current liabilities, which are those that must be paid within a period of 1 year or less. We have short-term debt with the bank, debt with buyers, other accounts payable, for example, taxes, employees, and others, as well as non-current liabilities, that is, all long-term debts with terms greater than 1 year, which can be 2 years, 5 years, 20 years, etc. And then we have net equity, which is financing with own resources, that is, those that do not necessarily need to be repaid, because they are not only exigible. That is why the net equity of a company is called non-exigible liability. And there we have the paid-in capital, which is the capital contributed by the shareholders, reserves when assets are revalued, retained earnings from previous years that have not been distributed, as dividends or withdrawals, and the result of the period, which is the net profit from the income statement that has also not been distributed to its shareholders. And here there is an exercise for you to look at, right, where we have different items from a company called Mall. Here, as you can see, there are 13 items, and what they are asking us to do is to classify each one of them, right? Whether it is an asset, liability, or pat equity. That will be available there for you to look at this exercise and how you can classify each of these accounts for the purposes of this arrangement of a company's balance sheet. And then there appears the exercise where, among other things, of course, the total assets must match the total liabilities and equity. So I leave that to you to practice in the following hours, times, and moments of reflection. So, well, having said that, let's now conclude this second session and stay tuned for what comes in the next session.